Hello, YouTube. This weekend, we're going to talk about what we need to do to survive a bear market or the next stock market crash. So, the first thing we want to talk about is just that we're actually back inside bear market territory with this weekly close, which means we are now 20% off the all time highs or below 384 by closing out at 383 this week. We also want to keep in mind that this has been the worst start to the 60-40 portfolio, or basically, stocks have had the worst start in 100 years. So, what does that mean? Well, to survive, we need to understand what this means. And there are two dominant patterns to look at going into the end of the year: a bearish one, or 2008 versus 2022, or whether or not that Santa rally is going to continue. Finally, we want to make sure that we don't fight the Fed. That is so important this week because those who fail to learn from history are doomed to repeat it. Winston Churchill. And a quote attributed to Mark Twain: history does not repeat itself, but it rhymes. So this weekend, there is a lot for us to unpack. And I'm going to ask you for a favor as we're getting started here. If you could please smash that thumbs up, it's going to go a really long way to support me and the channel. And also, we do still have our Santa special on thealgo.com. If you want to join us and trade with me, Justin from YouTube, you can have up to a 44% off, and you can find more about that at thealgo.com. All right, so let's understand, first of all, that we're in a bear market, and we can clearly know that by being below 384. If we pick up where we left off last weekend too, we are now seeing that we have these bearish weekly engulfing candles. And the reason why this is important is because what a bearish weekly engulfing candle tells us is that the bulls got quite enthusiastic. That's why we got the higher high, but then it all got flushed out. Dip buying was punished, and we're closing out near the low of the week, right around support. Is this actually going to turn into support? There is a pattern which goes back to 2008, which we're going to circle back to and talk about a little bit later. We got a failed breakdown, we got our 10-week pattern, we got our relative low. But just to keep it nice and short for the start here, we're just going to walk through the reason why this matters. Because looking here at the weekly chart, we just want to be very mindful of what we're being told, because there's a story being told here. The question is whether or not we can actually understand it. So SPY here, bearish engulfing weekly candle, check. Let's look here at QQQ. Same thing. That is correct. The same thing happened here where we have a bearish weekly engulfing candle where we have a higher high and a lower low, and we also close below the 200 weekly moving average. That's not really bullish. Let's go further down and see where things were versus last week, because there were a lot of charts which were closing above their 50 weekly. So even the Dow closing here by roughly 30 cents back over, bearish weekly engulfing candle, increasing volume. That doesn't look hot. The Russell, pretty close to a bearish weekly engulfing candle, but still nasty, closing below both the 50 and the 200. Looking here to RSP, or equal weight S&P 500, we see that exact same pattern, bearish engulfing. New York Stock Exchange, or 2,000 stocks, same pattern. If you look here to XLK or Tech, same pattern, bearish engulfing candle. Look here to ARK, even the same thing. Even though it's down in the dirty, nasty dumps, couldn't stop the sell-off. Bearish weekly engulfing candle. Looking here to XLV, bearish engulfing candle, but still above that 50 MA. But the pattern is what we're looking at here. Looking to XLF, bearish weekly engulfing candle. Oh, man, this looks like a huge pattern here. XLE, no. And that's pretty much where the story starts to stop. So at a very high level, we want to understand we're in a bear market. That is like really, really simple. I'm going to ask one more time here, if you don't mind, if you could please smash that thumbs up if you're still watching. And now we're going to jump forward because there is a lot for us to go through. So at the outset, that is the dominant story. And if we think about this, how do we want to survive this? Well, we need to make sure we understand what part of the pattern we're in, because if this has been the worst start in 100 years, it means that if you might have recency bias, which means that you might not have been trading long enough to have actually seen this, like going back to the 1960s or the 1930s or the 1920s. For me, I'm not old enough to have seen that. All that I have a recent recollection of is maybe going back to like 2008, but I was not active. I was trading, but I was not really active or knowledgeable at the time, which means my frame of reference is not going to be helpful here. So as we move forward, the 2008 versus 2022 template is pretty clear. We're either set to dramatically power dump, and I could see the reason why that would happen. The reason why is because the bond market right now is telling us that they are fighting the Fed. They don't believe them. They are pricing in rate cuts later in the year. And we're going to talk about that a little bit later here, specifically that the market is ready to move on, but the Fed clearly isn't. So who's going to win? It's a stalemate right now. But someone has to remind the market that the saying is don't fight the Fed. So if we don't fight the Fed on going up, well, wouldn't it be the opposite on the way down? Yes. Can we get a little bit more relief between now and end of the year? Well, if Santa Claus is coming to town, generally in the last two weeks of the month, but specifically, the final 5 days and the first 2 days of January is really when that kicks off. So based on all the seasonality, we're pretty much due to go higher right now immediately. We also want to keep in mind whether we should be fighting the Fed or not, and people want to do it. So we're just going to start closing some of these out because the story's now been told. Don't fight the Fed. What does that mean? If you don't understand that we're having the worst sell-off in 100 years, well, you might be doomed to repeat what's happened before. Smart money, dumb money, doesn't matter. Everyone's getting hurt. And we have to look for whether or not it rhymes. So 2 weeks for a Santa rally versus the 2008 versus 2022 was tracked all the way till now. Looking at the fear and greed as well, just before Jerome Powell spoke, we were sitting here at 60, and now we're not. So if we look here to our timeline, we were at 60 only on Monday, and then closing out here on Friday, we're down to 42. We've lost a third. We're back down into fear. There's not even extreme fear yet. Why? People don't. They're fighting the Fed. They don't believe them. Worst started in 100 years. That means a lot. Also, the stock market was so bad in 2022 that even hedges wouldn't have helped you. Whoa. They're talking about here where if you would have just bought, options were not even expensive this year. So if you would have bought just one, you're fully invested, you would have bought one monthly expiry for SPY puts, you would have still lost. You would have lost 19.6% versus the S&P total return only being down by about 17. Man, this is like a tough market. Absolutely, it's a tough market. So if you're looking for people who you can trade with to try to gain an edge, you can trade with me, Justin from YouTube. And I'm only going to mention this once. We have a sale on for the next 2 weeks where you can join me and see everything we do after YouTube to try to formulate a plan and to try to learn from history to make a specific strategy to try to conquer the market. If you want to join us, great, thealgo.com. Thank you so much. Moving forward here, part of what happened on Friday as well and this week and why we need more feedback is that stock bulls lost support of roughly $2 trillion in options expiry, which was triple witching. So if we look here, we had 2.4 trillion in SPX expiring pre-market on Friday with the E-mini futures, and then about 1.2 trillion expiring on Friday. Let's go back to the chart and let's see what the daily chart tells us here. So the daily chart tells us that we had a gap down, but relative to the open, we actually didn't close all that bad. We opened at 385 and closed at 383.5. So about a $1.5 move from the open. Why? Well, because most of this rolled off right at the open. So if it rolled off, there's no more motivation. What's interesting here is that on SPX, what we just looked at, there's also going to be a final potential boost for the bull. So we're going to go quickly through the bull and then the bear potential, and then we're going to go talk about the Fed. Then we're going to go back and look at all the charts. So I have a lot of evidence this week. I'm feeling a lot more confident than before. But as always, we want to make sure we are expecting the best. We are prepared for the worst, but most of all, ready for a surprise. So what could surprise me next week? Well, a move higher would surprise me. I see a technical reason. I see some options motivation. I also see a sentiment reason. But let's try to go through and try to provide the evidence here. So when we look at SPX quarterly expiry, which is going to be on the 30th of December of 2022, there's a number that sticks out to me like a sore thumb. It's right here at 38.35. And the reason why is because there's 42,000 contracts here. SPX is 10 times bigger than SPY. So when we look here, these 42,000 in open interest, as of the close, they lost about $170 million on Friday, but this value here is still about $275 million. So if we take 38.35 plus 65, it equals 3,900. And this is the equivalent of almost a 500,000 SPY calls. There's nothing else on here which sticks out to me like a sore thumb. This one does. So there might be a final roll-off to happen after this OPEX going into the end of the year because we have a perfect 2 weeks left, which means that next Friday or on December 30th, we're going to be closing out the weekly, the monthly, and the yearly chart. We have 2 candles left on the weekly. We got 2 weeks left on the monthly, but next Friday, meaning the 30th, we're going to be closing out again one more time the weekly chart, the monthly chart, and the yearly chart. So we have to make sure we understand the higher time frames are converging to close at the same price, which means whatever price we get next Friday at the close is going to be where we get the yearly, the monthly, and the weekly candle close. Really, really important. On the flip side, going into January, bears are piling in, which means they want more downside right now. So what did they buy? Well, they were going in pretty heavy here, buying up these 380 puts worth about $8, which means we're going to be revisiting a low 370s if they want their money back. Other than that, there's 100,000 here at 390, and that might be a put spread. I don't know. This just really sticks out to me here with this this volume at 380. So for the 16s, or what's most likely going to pay out, this is where people are focusing. They're buying out of the money puts for January. Finally, if you want to survive this next stock market crash, I'm going to give a thank you to Blake in our group for sharing this here, where people make fun of Warren Buffett for the last couple of years because he was boring, predictable. But isn't that what we want if we show up for work? Which is what we talked about last weekend. Do you want to be right, or do you want to make money? Well, Warren's not out there talking every day or doing all the stuff Kathy does. Why? He's focused on making money. Kathy is focused on being right, it appears. So who do you want to be? The boring Buffett who makes 56%, right? Making barely any trades, or Kathy who's in there trading every day, right? Like a superstar, losing 5% since 2017. Well, we'll find out. And I'm sure people in the comments are going to leave me some notes as well. So make sure you tell me what you think this weekend. I would appreciate it. One more thing to talk about here is that for everyone talking about a Fed pivot, we haven't even had a pause yet, right? So why are people fighting the Fed? And the market's already discounting the future, the bond market specifically, which we'll talk about later. But everyone talking about a Fed pivot is way ahead. We don't even have a pause yet. We're still hiking rates. So when the Fed pivots, if we understand history, like we just mentioned before, going back to the 1960s, that's way before my time. I wasn't even born. Negative 36, negative 48, negative 27, negative 51, negative 58, or negative 35. And that is from when the Fed pivots, not from the top. So why is that so important? Even Jerome acknowledged that 2001 was a shallow recession. We dropped by 51%. That would be 51% from here as the guide. Is that what I'm predicting? Not yet. Not my base case, but it's possible, probable. We'll find out. But we have to be mindful that everyone who is looking for a Fed pivot doesn't understand what happens. The Fed pivots when something breaks. Things are breaking. Look at FTX. Look at the gilt market in Europe. Things are clearly breaking, but they have not broken. That's what's so important. The Fed is only going to pivot or deviate from its plan later. And I'll briefly explain the reason why. It's because they're worried about their credibility. They were late to the party in terms of transitory and raising rates, which means they're going to be slow to start cutting. Whether that means that they do damage like they did over here when they were slow to hike, they're probably going to do damage over here. Why? They're worried about their track record. They're worried about being right, not about saving what is most important. That's what I think the big disconnect is here. And one more thing to look at on the charts here, just to provide some evidence or credence, is the Fibonacci retracement. So if we understand that math really plays a big part into the charts, where are we right now? Well, we're here to the 23% retracement from the all-time high to our October low, which means if we lose 379, we're probably going to go down for a full retrace. However, what normally happens is we dance between these Fibonacci levels, and there's a big hole here. It's much bigger than the 38 to 23. So we're going to need another fresh catalyst. I think it's going to be the new year. Post bonuses for Wall Street and a lot of people getting laid off, as we saw at Goldman Sachs. So there is the strong support on the monthly chart, which is going to be here going back to our May low. It also corresponds with our weekly low here. And we have that 379.53 area. So if we're looking at QQQ on the 1 month chart as well, yeah, we have a dominant bearish pattern. One thing I'm focusing on, which we will review a little bit later when we look at the charts, is that look at the 50 MA. So we touched it now basically 3 times. We got 3 monthly candles here where we touch it. And what I want to watch here for feedback is that, well, they were so aggressive buying it up the last 2 times on the 50. So if they had a chance to buy it up twice, low, higher low, massive hammers closing out above the candle, is it safe to assume that we would find buyers again on the 50 MA? I would think so. And if we don't, that'll tell us even more than if we do. They've already had 2 chances to buy. They got aggressive because we got green candles with higher lows, but we have a dominant red pattern. And that is why we want to make sure we understand at which point the chart is breaking bull and what point the chart is breaking bear. So stay tuned. I'll provide specific updates on the bull and bear thesis. And hopefully, so far, you guys are enjoying the content. I'll ask one final time if you could please smash that thumbs up, and then I won't ask again. Thank you so much. All right, let's jump forward. So moving forward here, looking at the next part here, the Fed pivot is not going to save us. When the Fed's going to pivot when something breaks. So yeah, things are breaking and people are trying to fight the Fed only on the way down. On the way up, they're like, don't fight the Fed, don't fight the Fed, bye, bye, bye. On the way down, no one wants to believe them. We're already down a lot off the all-time high. So here's the pattern I mentioned briefly at the outset as well, where we're comparing 2008 to 2022. I think the line chart, right, that humble line chart we showed earlier provides a lot more context just because people don't always want to see what they want. However, what I'm looking at here is a specific pattern where we have our channel lower. We have our 10-week pattern here where we go up for 10 weeks in a row from our October low to our December high. It's perfect. Exact same thing over here, 10 weeks higher. There's our rally. And now what I'm looking at is the relative low, or this red line, the red box and the green line. Same thing here. So in 2008, this is here at 1370, and that is where we found a bounce. So we found support right here. We look at the line. We bounced off the green line. That's exactly where we are right now. If we're matching it perfectly, we should actually be up here at the February low. But keep in mind that this is a template. It is not a guarantee, like Mark Twain said. It doesn't repeat itself, but it rhymes. And this still rhymes for me. This was a great template for the last 10 weeks. So if we're going to repeat 2008, I want to be very mindful of the downside. And this is where we can get some actionable insight from the video. So looking here, if you look here now, we got a blue arrow, and there's a title here that says failed breakdown. What is a failed breakdown? A failed breakdown is when we break down, but then fail to hold it. In 2008, we're looking here at that at the blue arrow or the green line, which is where we would be if we're on the 11th week. So when we look here now, bearish engulfing weekly candle in 2008, check, just like we do now. Closing out below the lows, check. Closing out below the lows, check. So it seems like pretty accurate. We have a key relative low that we're trying to bounce off as well. So going back to May 19th in 2008, our low is 1373.72 cents. Here we got 1373.07, or a marginally lower low. And then we close out near the high of the week. So if we're going to be bullish, we need to either have a failed breakdown or have an inside bar, which means a higher low on the weekly. Or if we're going to break down, we have to recapture it fast. We cannot get a daily close below this week's low at 3827.91. That is really what it comes down to. And what that means is that we're going to be holding the potential for the zone, and we could be looking for some upside relief back up to as high as about 400. Why? Why 400? Well, because there's an article here I'll bring up in a moment. Let me just actually see if I can find it. Where's my bull thesis? I have some notes here. It's because 4,000's been acting as a push-pull area. So would it make sense that post-triple witching, we would see a revisit of this area? Absolutely. Let's read this headline here. S&P has mostly been trapped within a 100-point range of 4,000. So 4,000 SPX is 400 SPY. And we've been doing a push-pull between 3,900 and 4,100. That's the zone we've been battling for. So if that's the case, would it make sense that if post-expiry, which is what we normally do every time, we get an upside move, which would be opposite to the true move? Yes. If we're actually going to be going down to 2008, look over here. It's a waterfall. It gets like really, really bad. It gets really bad. So let's just look here to 2008 really fast. This means that we're going to start taking the elevator down. Staircase up, elevator down. Whoa. Yeah, let's make sure we're ready for it if it comes. So what would that mean? It would mean we get an opposite move, trap the bulls one more time, reset the fear and greed, and then we waterfall. Why? Triple witching means that we're closing out the quarterly expiry on a lot of exchanges, on 3 of them. That's why it's triple. And if the true move is going to be down, they're likely going to want to scrape the chain. Will they be successful? I don't know. They're going to probably try, though. Why? They always do. That's how the stock market works. Moving forward to the bull case here. So is the third time a charm? Let's look at some evidence, because this is really important. It's what I use for my bull thesis. I'll briefly remind you what that bull thesis was, and then I'll tell you the reason why it's invalidated now. So if we look back here to our monthly chart, and we look to the previous times where we tested the 50 MA in the last roughly 10 years, Yeah, call it, I don't know, call it 5 years, sorry. So looking at 2018 and 2022, what do we have? Again, we're not talking about the fundamentals here. We're purely talking about technicals. Bounce off the 50, bounce off the 50, bounce off the 50. Check, check, check. And then, sorry, let's go back here to the monthly. What do we have here now? Well, we got at least two candles. Here we got four. In 2020, we got five. So four back-to-back green. In 2025, back-to-back green. Well, what do we have so far in 2022? Let's delete the lines and then we'll just bring them back after. So far we got two that are green and we're halfway through the month here on December 17th. So they can still go green. I don't think it will, but we could go green. So check, 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 check. Just the fact that we're red is what's missing, but we do have that higher high. Now let's look at the final piece here. It's the three candle. It's a third candle. In 2018, the third candle back tests the first green candle. In 2020, the third green candle back tests the first one as well. What does that mean? It means we bounced by roughly 2 points. We saved it, right? We saved the high by about 2 points in 2018, by about 2 points in 2020, and in where we are now, the area we had to save was 389.52. Now let's look at our weekly chart. Why? Last week we saved it, 39164, exact same pattern. And then we got the higher high. The bulls looked like they were in charge after CPI. And then what happened? Bearish engulfing weekly candle, which means they lost. It fizzled out. Dip buying got punished. So it tracked perfectly up until last week. And then after it lost 390, it sliced about 10 points lower to 381. Oh, so this was not my base case. I was looking at what was the bull thesis. And now the bull thesis is pretty weak. It's not dead, but it's definitely getting weaker. Third time doesn't appear like it's the charm. Why? Because it fizzled out. Let's look at one more piece of evidence here. Every previous time we peaked out in the March rally, the June rally, and the October rally, we fizzled out when we got above 60 on the fear and greed. Where are we now? Oh, man, we're back here 42. Let's look on the timeline, though, because it'll give us an idea of sentiment. Why? Because people get greedy, people get fearful, and it repeats over and over. There we go. So there's, let's just go back to here. So there's the top, there's the top, there's the top. We just talked about it. There's the top, waterfall down. There's the top, waterfall down. Third top, it doesn't look like it's different. Third time's not the charm. Third time is still a trap. All right, let's look at one more thing now. If we're going to go back here to our previous pattern here of going back to October 10th low, let's see what people have been doing in terms of buying big options. Why? Very clear story for me. Here on our platform, thealgo.com, which you can get access to right now, that Santa special I talked about. You can go to thealgo.com where you can trade with me, or you can just sign up for the platform. That's the standard plan. Anyways, I'll give you the hot tips. Here you go. We're looking back here to October 10th to December 17th, basically since the October low. And now we're going to look at the options here and see, all right, there's a put call ratio for orders over 100,000, all hitting the ask. If that doesn't make sense to you, just know that this is smart money buying at the ask. They desperately want these options because they're they're buying at the ask, which means give them to me, give them to me, give them to me. Flow is bearish. 1.4 puts bought for every call, but we're tracking volume. We're not tracking value. We're going to have that tool coming soon. But anyways, as we look here, look at just look at the screen and tell me whether or not you see dominant red or green. These are sorted by premium. The largest order here is SPX for $989 million, but it already expired on the 15th. So now, if we look across here, what does it tell us? There's two things I want you to pay attention to. There's the expiry, but then also the dollar value. And why? Well, because most of these expire on Jan 20, that same expiry I just showed you. These are deeply in the money at 5,000, which means it's a synthetic short, and they're big money, 400 million, 300, 200, 200, 100, and it's mostly red. For when? They're all positioned for roughly the 20th, Jan 20th of 2023. So let's just go through here and visually scan it. All right, mostly red, mostly red, mostly Jan, mostly January, mostly red. Now we're at $100 million here, still at 100 million. Whoa, it's like, oh, wow. It's like really red. And it's like pretty dense here. Now we're going out to 2024. But the theme for me is still mostly Jan 2023 and mostly puts. And this is for everything we track. 80 million now, 70 million. It's still the same pattern for me. 60 million, 50 million. So even as we go down here, oh, now, no, we got a couple of green here. Whoa, okay, maybe it's Christmas, right? More red, more red, more red, more red, more red. So the pattern here for me is dominant red, but this number here doesn't even accurately predict the dollar flow. Dollar flow is significantly bearish. Now let's look at one more indicator here. Let's look at the overview, which means we're now going to look back to roughly the last 2 months, or October 10 to December 17. And we're going to exclude SPX and XPY and QQQ to purely look at single stocks. But at the outset here, look, 21 billion long on SPX and calls, 30 billion short on SPX, bearish net. SPY has more bullish flow here. 13 billion versus SPY at 4 bear. So we'll scratch those two out. SPX, SPY are roughly neutral. Now let's just look down here to single stocks. Oh my goodness. Tesla, 9 billion, 9.5 billion short. On the call side, 1.4 billion long. What is that? That's net premium, 8 billion short on Tesla. How's Tesla been doing lately in the last 3 months? Let's look on a 1 month perspective. Oh man, it's been like straight down, and there's actually a gap on the chart here. It's been like straight down from 250 down to 150. Whoa, that's like a big move. Thanks, Elon. Appreciate it. 40% down. Yep, those got juiced up. So that's the biggest one here. Huge, huge, huge bear flow. Accurate predictor. Second thing I noticed is that we got 8 billion on Amazon, 8 billion on Meta, 7 billion on Baba, and then we got Netflix down here. On the call side, man, MIA. If the third time's the charm, why does anyone want to buy it? If we're truly going to get a Santa rally and more, why are people not buying it? I don't understand. It doesn't make sense to me. So if we look here at Amazon now, 400 million long and 8 billion short. Whoa. How's Amazon done in the last 3 months? Oh, terrible. It's done terrible. From about 113, 116 down here to about 85, or about a 23% decline. Accurate predictor too. So for the broader market, even though we're getting a signal here that it's roughly 1.5 to 1 for puts, it's actually more skewed. We're going to be launching a feature soon, which is actually going to show premium. But drop me a comment and tell me what you think too. Do you rely on this? Is it we're reading too much into it? These are billions of dollars. This is not like small orders we often see shared by retail who are like, oh, 100,000 this, 100,000 that. Man, these are billions. These are like tens of billions of dollars. There is no dumb money here. And we're going to be launching our dark pool feature soon, probably in the next week or two. And we'll have more insight on that for these videos going into there. There was tremendous activity on Friday, notably into the close. Billions of dollars transacting. Okay. So now we understand all the backdrop. We understand we're likely in a bear market until proven wrong. The final insight here. So we know the bull scenario. We need to go for multiple weeks with higher lows and higher highs. The bear scenario. So final thing here. Sorry, let me step back for a moment. If we now look to where we are now, or right added this blue line, I try to make this chart as easy as possible. You can pause the video if you want to see exactly where we are, to understand, like the video describes, how to be prepared, tips for surviving a stock market crash. Look at the weekly chart. If we are repeating 2008, we're not going to form weekly higher highs until we get our bounce off the bottom. So low, higher, low, lower, high, lower, high, lower, high, lower, high, lower, high, lower, high, higher high, dead cat bounce. And then what? High, lower, high, lower, high, lower, high, lower, high, lower, high, lower, high, dead cat bounce. We're not going to dead cat bounce until we're able to form at least 2 back-to-back weekly higher highs. So far, we got 1 here. So we got 1. It's not good enough. We need 2, which means next week we got to go to 4,100. Whoa, we got to rally up 250 points. Yep, at least 250 points minimum. We're not going to get a higher high without it. So what does that mean? We defer to the following week, or we're in a bear market and the bears are going to control. We're going to get a relief rally and then slam it all the way back down. What would relief look like? Relief would look like a move back up to as high as about 400 to fill this gap here. It would also correspond with a head and shoulders here. So let's just look. Where did we dead cat bounce back up to? Roughly a head and shoulders, right? Roughly back to our previous top. Where's that here? Well, it's about 4,000 to 4020. Okay. So we could go back up to the psychological 400 for what? An options reason, a bear market pattern. But here we also note that the Fibonacci levels are being respected. So here we got 379. Let's just look at them close. So we got 379, 398, and 414. What was the high in pre-market we formed on CPI? It was 414. Where did we basically start rejecting off of? Well, about 398. And where are we sitting right now? 379. So there's multiple reasons why these areas are significant. Are they going to hold? Well, that's what we have to do as technicians. I just told you the cheat codes, right? The higher low for the bears, for the bull, sorry, or the failed breakdown. And for the bulls, it's just business as usual. We get 2 consecutive daily closes below the 50. That's it. It's over. We're pretty much already over. It's just a matter of when we find relief and where we find sellers. That's what I'd be looking at. So it's already been a 30-minute video. What I'm going to do now is provide a few more things to be aware of as we're going into being prepared for a potential stock market crash. So what I want to talk about specifically is so we talked about how, let me actually flip to a weekly chart here. I want to make sure we understand that it's one thing to be bullish or to be bearish. I highly encourage you to not flip-flop on teams, which means if you want to be bull, look for the bulls. Look for the bull setups. If you want to be bear, look for the bear setups. But if we now think about this, our close on the week, which means that we had about 4.5% to the upside, and on the downside, we had about 3% down. Here, we're just looking at SPY. If we look at ES, which includes the CPI pre-market move, it'll be bigger. But ask yourself this: do you want to be Kathy Woods, where you look smart or look cool, or do you want to make money like Buffett? Why? Let's just look at this here. So from the close last week to our high of the week, it's almost 5%. It's like 4.5% here to the high. It's actually higher. We went to 414. So 414 is about 5% higher. We're going to call it 4.5 for the cash market. Looking to the low of the week, it's about, it's not even 3%. What does that mean? There was more potential to make money going bullish if you bottom and top ticked it perfectly, which means you sold exactly at the high and you held on from last week versus just holding on from last week. And if you were short and then going down to the low, which means if you were bearish, you lost more than you gained. You risked, right? You risked 3%. You risked 4.5% to make 3%. What is that? Well, it's 3 divided by 4.5, which means that you risked $1 to make 66 cents. Yeah, that was this week's risk reward, whether you're aware of it or not. If you didn't have stops, you just got trained to not use stops. If you're right, make 66 cents. If you're wrong, lose $1. I'm not saying that's what's going to happen next week either. We're going to find out. I think now the risk is skewed to the downside, but it doesn't mean we can't find relief again. I need to probably at least see a rejection at 390. Otherwise, I can't say what's going to happen. We need to see where the bears regather steam and re-attack the chart. Right now, we're waterfalling. Let's go back in time and look at one more thing here. Why? Because when we leave at least 2 daily gaps on the chart, we usually at least get a dead cat bounce. How high? We'll find out. So let's look back here to our move here. So 1 gap, 2 cap, dead cap, 1 gap, 2 cap, gap, going back to June here, 1 gap, 2 gap, dead cat bounce. We ultimately go down and then a little bit lower and higher, but there is relief on the chart. I'm not calling for a reversal. I'm calling for relief. And is there another period here where we got 2 gaps on the chart? I think that's probably just sufficient. This is where we started to really get scared. People are shorting the hell out of the market. And now we're going to find out whether or not they want to continue. So that's like really important. Second thing is that it's been a really tough route so far this year. And it's okay to be wrong. It's not okay to stay wrong. So make sure you stick to your team, whether that's bull or bear, and then just don't deviate. And be very mindful of this 384 area. That is where the bear is defined. Negative 20% into the yearly close. We're closing out the year in a bear market. Worse since the great financial crisis. Do you want to look cool or do you want to make money? That's the, do you want to be Kathy or do you want to be Buffett? Buffett is boring, predictable, barely makes trades, makes 56%. Kathy, right? She's in there. She's a superstar, right? Trading. Hot on the way up, terrible on the way down. I don't know. I prefer to be Buffett, but you're not going to look cool though, right? That's the trade-off. And you also have to understand those quotes we told you from Winston and Churchill, and also from Mark Twain. And I know it's not a Mark Twain quote, but it's attributed to him, so I'm using it there. Let's make sure we're still recording. Perfect. And this video is going to act as our template going forward. So I'm now going to talk about the Fed. This is my point of view, and I think that there's been a lot of commentary about the Fed. I'm going to provide my 2 cents on here, and that's all they are. They're just 2 cents. Why? I don't work at the Fed. I'm not trying to tell the market what it's doing. I'm trying to just listen to understand what the Fed's telling me. Again, they're probably late to the party. They're always late, but they're determined. So they want to be right. They were slow on the way up, which means they're probably going to be slow on the way down. And I'll actually go through 2 things really fast now, because I think it's really important before we look at the backdrop here that we understand what the market is telling us before we look at the evidence. So here's what I'm reading or understanding from what I'm being told here. I'm going to look at two charts right now. I'm going to look here at the 2-year note and look at the 10-year note. The 2-year note is down by 3.8%. We're down here to 4.18. Looking at the 10-year note, down by 2.6, which means they're voting and saying inflation's peaked, and the Fed is not going to be able to get higher. The 2-year note should be above 4.25, which is the lower bound on the Fed's current rate. So the market is voting and saying, we don't think you're going to go higher. That's what I'm hearing here. They're fighting the Fed. Don't fight the Fed. Someone better tell the market, because the markets are ignoring it. They've been ignoring it for a long time, and the markets have been right. They called they predicted the reversal before the Fed. It led the market, but now the Fed is determined not to look dumb twice in a row. They were slow on the way up, which means they're probably going to be slow on the way down, like we showed you before. They're going to pivot when something breaks, when growth is at risk, when a recession happens. That's what I think. Final thing to look at as well is that we also have VIX actually closing the week out 19 cents lower, which means people were hedged into Powell, into the CPI, not post. So they're like, yeah, cool, whatever. We don't care. We don't need protection. That's why I think VIX is down. So right now, I'm getting a flash here that the market is not pricing in recession. The market is trying to it's playing chicken with the Fed. I don't want to fight the Fed. That seems like really hard. And the last thing I'm going to talk about here is just a cheat code. Probably should have mentioned this at the very beginning. A cheat code meaning that if you want to understand whether or not you are fighting the market, what I would really encourage you to think about is people often talk about a bull and a bear. So I'm going to talk about three scenarios here: bull, bear, but then one that people talk about sometimes, but not all the time: kangaroo. And why is it important to talk about the kangaroo? Well, because this market's not normal. A bull market means we go up. A bear market means we go down. A kangaroo means we go choppy. I showed you. Being hedged this year, you lost money. Holding out the stocks, you lost money. Going short, you had to time the market, but you made money, which means we're in a kangaroo. Let's look back here at the weekly chart and try to understand that. So the kangaroo for me just means that we're dancing between the 50 and 200 moving average. And let me just blow this up here so it's a little bit easier to follow. We've talked about this many times before. So if we delete everything again, now all we want to do is go back in time and look at history. Why? We looked at the quotes already. I don't need to remind you. Looking here, if we're over the 50 and 200, boom. If we're stuck between, it's choppy, right? Chop, 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 bounce around. Once we go below both, there's the drop. Stuck in between here, where is it easy to trade? Over both. We claim both the blue and black line straight up. That's into 2008. Then what happens? Choppy. Finally get confirmation we're below both. There's the nasty drop. This is choppy. That's nasty. And then what happens? Well, we take a long time to rebuild back up steam, get over the 50, test the 200, come back, finally claim both. There's our expansion, but we fizzle back down. And then what happens? When does it get easy again? It gets easy when the 200 is below, 50 is above, and we reclaim both. Leads to a beautiful expansion here. How long? Years. Years of expansion. Years where you just buy and hold. Whoa, that seems like really easy, Johnson. Are these cheat codes? If you're investing, sure. Why? Because the monthly chart is what you should be using for your investments. And we look here to 2016, 250 over both, nice expansion, falls below, bounce off the 200, back over, nice expansion. It's a super simple pattern, but people fail to understand it. What it means is that the long-term price is the lowest price, the short-term price is the highest price, and momentum is to the upside. That's why when we're over both, it's easier to go higher. There's less friction. And right now, what's been the pattern here? It's like 2000 or 2008. Okay, so over both. So 2018, right? Bounce, boom. 2020, bounce, boom, over both. So far, there's no bounce, boom. It's bounce, fizzle, lower low, lower high, lower low, lower high. And that's like, it's like perfectly rejecting off the 50, bouncing off the 200, rejecting off the 50, bouncing off the 200, rejecting off the 50. So what can we assume? Well, it's a kangaroo. It's a bull market if we get back above both. And that's where we can have years of expansion where it's easier. Is it a guarantee? No, but that's where it gets easier. I like easy. I want to be Warren Buffett. We look at the bear. We showed you too. When we get below both, that is where the bear's confirmed. We also have our pattern right here. It shows us. If we're going to get that lower low here, we are going to form a new low of the year. And we're going to be below the, let's pull it back here. We're going to be below the 200 MA. So far, we've bounced off of it. So we bounced off it before twice. What did we do so far? Well, roughly twice. That's why I'm using it as a template, not a Bible, not a guarantee. But when we lose the 200 on a weekly closing basis, and QQQ already did it, by the way, it's done it multiple times. Two below, that's probably it. Another dead cat bounce, and then we start fizzling. It's super simple for me. Hopefully it's getting simpler for you. If it is, please smash that thumbs up. Volume's also drying up. So what's there potential for? Well, there's potential for larger moves because volume is drying up. At the same time, the Fed is reducing the balance sheet, which means that there's not going to be a lot of liquidity in this market. That is the template. Don't fight the Fed. All right. So tips for surviving a stock market crash. I think we got through a lot of them. I think I got some notes on the other screen here. I'm just reviewing. Bull thesis we talked about. Santa rally needs to continue. Last 5 days of the year, 2 first days of 2023. QQQ off the 50 monthly, right? We got a bounce here. Bearish pattern, but yeah, we have to look at the dip buyers showing up at the 50. Are they going to show up again? Well, we're below the 200 on the chart here. So actually, sorry, I forgot to finish off the story. So we looked at the weekly here. We're in a kangaroo. So I want to make sure I don't confuse things here. So I'm going to take a step back, slow down, and then the video is just going to be long. I'll have to deal with it. Let's go back here. So it's going to be a long video, and I'm going to even rewatch this myself after. So here we got 1 week. I'll call that an invest. You're an investor. For 1 day, I'm going to call you a swing trader, which means that's a time frame I like to use for these different ones. And then for 1 hour, you're a trader. So what does that mean? It means if you were trying to trade or hold for a couple of days, look at the 1 hour chart. Are we in a kangaroo, bull, or bear? If you're a swing trader, look at the 1 day. Are we above or below the 50 and 200? And then for an investor or the 1 week, are we above or below? The question is whether or not you're going to have the patience to hold on. And what I mean here by patience is patience. Will you be able to afford to wait for the ideal opportunity or a sniper trade, which is what I call those? So good you can't say no. And if you can't draw fancy trend lines like me, and again, I'm not Nostradamus, I'm not Picasso, I'm just some guy on YouTube. Take what I say with a grain of salt. Well, now let's look here. Let's delete everything again. Let's look at those time frames for 1 hour. Okay, we're below both. Yep. So we're in a bear, and we're about to get a death cross. That's pretty obvious to me. Okay, let's look at the daily. Below the 200, below the 50, but only 1 time. I would like to see a second daily candle close below the 50 to start showing a trend change, and that's where the bear would get more confirmed. As of right now, it's confirming, not confirmed. ING versus ED. And then we looked at the 1 week. Well, here we're stuck. We're a kangaroo. So kangaroo on the weekly, bear on the daily, confirming, not confirmed. And then here on the hourly, confirmed bear. All right, so take your pick. Make sure you're not fighting the trend. Don't be that fish swimming upstream. Now let's shift gears here to understanding what the Fed is telling us, because I do not want to have to mansplain, but I feel like I have some insight here, which if I put it in the video, it's going to reinforce it for me too. So I want to thank a lot of people in our group as well, because they've been saying that they've been noticing a change in the way that I'm trying to teach. And teaching is the last step to mastery. Last step to mastery. My goal is to become a stock market master. Am I there yet? I think I'm on my way. I don't try to get too high on my own supply. I'm not Elon Musk. I try to be humble. And the reason why I love doing these videos is because teaching for me means that I'm going to get better at what I do. So if you notice the comments or the people in the chat who we engage with, it's generally people who are trying to show up and learn, because that's why I'm here. I'm not here to look cool. I'm not here to be Cathie Wood. I want to be Warren Buffett. I want to have longevity. I want to look back and be proud of what I've done. And we've talked a lot about our group lately. I don't want to do a hard sell. If you want to join us, great. We got a free trial. If not, just try to think about that when you're watching these videos. My goal to be here is to not be your best friend. It's not to be it's not going to be the yes man. Oh, well, yes, every trade you make is smart. I'm here to try to teach you and to give you the benefit of my experience. Am I the best? Probably not. Do I know everything? Nope. I'm humble though. I know what I know. I know what I don't know, and I don't pretend. You're never going to see me pretending. Confidence. One more thing here. I don't want to pretend like I'm confident all the time. Why? That's a con man. A confidence man is a con man. So if I'm not confident, I'm going to tell you. I know what I'm confident in. I know what I'm not in. A con man is always confident about everything. Take that with a grain of salt. Someone who's always confident is not aware of their own blind spots. I have blind spots too. It is impossible for me to be confident about everything. Why? Markets taught me that. As soon as I think I know everything, man, black eyes, black balls. That's what happens to me. So if your goal here is to show up and be a student, I would love to have you. That's the comments I generally like more, is people who are showing up to try to learn. It's also because I'm showing up on YouTube for me. I'm being greedy in order to be generous. If I can become a master, I can help more people, including myself. So just try to keep that in mind. If you're watching after the 45-minute mark, I'm guessing that you've been watching all the way through and you have the right intentions, and you are the people who I want to help, which is why I'm trying to lay out as much stuff as I can publicly. But again, as we talked about on Friday, all the best stuff is going to be reserved for our group, where I give you cheat codes. You can see exactly what I'm buying and selling. If it interests you, come join us. All right, moving forward now. So I'm probably not going to repeat all the stuff over and over. I'm going to have a cheat code for our group, which I am going to use as a guide going forward. So I talked all about the bull case. I talked all about the bear. I talked a lot about the bull case. We're going to talk about the bear case now. I'm actually going to skip those notes. So I'm going to just go through and present the data. Then I'm going to come back and see where we're at. So column, don't fight the Fed. Someone better remind the markets. Let's read the first paragraph or two here. Don't fight the Fed is one of the most hollowed commandments in financial markets. The other hollow commandments are rule number 1, don't lose money. Rule number 2, see rule number 1. Well, people are losing money and they're fighting the Fed. I don't know why. It does not make rational sense to me. Why? People hate losing more than making. And right now, everyone's got egg on their face. Everybody. It's few and far between to see people who are green year to date. But for the most of this year, traders, investors have ignored it. It turns out that playing some Fed policy turn in 2023, rather than guessing any absolute peak rate itself, would have proven lucrative even in the face of a constant Fed pushback about possible easing next year. Even though 2022 will be one of the worst years on record for a range of assets, from stocks to U.S. Treasuries to corporate bonds. We showed that earlier, worst 100 years. The damage was largely done in the first 5.5 months of the year. That was when, against a backdrop of surging inflation, the Fed's original pivot to its most hawkish policy stance in decades took investors by surprise and markets crashed. Why? Excuse me, I got my nose congested. It's because this is not something we've seen recently. Got to go back probably 50 years to see this. So people's recency bias is buy the dip, buy the dip, buy the dip. It's why there's the adage of BTFD, right? Buy the effing dip. Where did that come from? Well, you got punished if you didn't, even if you disagreed, right? BTFD, that was the strategy for a long time. BTFD. But that's still fighting the Fed at this point. We fight them on the way down, but on the way up. But since mid-May, when rate futures began to bet outright that the Fed would be cutting rates in the second half of the year, the markets have stabilized. So that's the put. It's the bond market. The bond market is calling the Fed's bluff. That's the easiest way to say it. They are today pretty much where they were 7 months ago, and in some cases are even a little higher. So to not overcomplicate it, let's just read the final paragraph here. To be clear, traders have not swung completely against the Fed. Rate futures have raised the 2023 implied Fed funds rate to 400 basis points to around 5, but it has raised its dot plot forecast in a broadly lockstep move. Blah, 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 blah. Let's just skip the rest. Here we go. Higher for longer. That's the takeaway, right? Higher for longer. That's what the Fed's telling you explicitly. Let's read the next one here. It's easier. The market is ready to move on. The Fed clearly isn't. So the market wants to go higher, wants to ignore the Fed. It wants to look through the recession. It wants to move on. The Fed clearly is not. So if we're not fighting the Fed, we need to be mindful of this. We're buying into a market that is fighting it. Let's read the subtitle here. The central bank is taking every possible opportunity to remind everyone just how little has changed. Let's look at the next article now. Here's what's changed in the new Fed statement. Almost nothing. Just look at the red line crossed out. All right. 2 words. 2 numbers. That's it. So one more time. The market is ready to move on. The market clearly isn't. The central bank is taking every possible opportunity to remind everyone just how little has changed. And there's 2 words that changed and 2 numbers. Okay, so that seems like really simple. Yeah, don't fight the Fed. Don't fight them. Someone better remind the market. When? I don't know. But that's when I think we're going to see yields turn back up and the VIX is going to get jacked up. There has to be something that gives here. Something has to give. Otherwise, the market's going to discount it. Sorry, wrong chart. Let's move forward here. So what does that mean? Well, again, the Fed is basically saying, stop betting against us. That's why Jerome Powell was trying to jawbone it. Jawboning means he's talking it up really hard. He's basically told us, I'm not pivoting until something breaks. So what's going to break? Well, we don't know. That's why it's usually a black swan. Something breaks. There's tons of warnings, though. Let's move forward. Dally from San Francisco, one of the most dovish members, by the way. It's important to say we see nothing but hope in the inflation data, not confidence. Whoa, from a dove? Wow, okay. Let's move forward. She's just one person. Let's look at the Troika. John Williams, Lael Brainerd, and Jerome Powell. This guy right here specifically spoke this week on Friday, unscheduled until after Jerome spoke. Why? I think he's out there to massage Jerome Powell's story. I listened for what he was saying, not what I wanted to hear. What did I hear? Very obvious to me. Here's what the market's focusing on. The market's focusing on CPI. What CPI is the Consumer Price Index. It includes a lot of things like goods and blah, blah, blah. Looking here at the graph or the last couple of months, yeah, there's a trend here. We peaked and now we're coming down. The problem is that the Fed doesn't care about CPI. They care about PCE. So if we're not fighting the Fed, and John Williams basically explicitly said, we're taking the, do I have the image here? Let me see if I can pull it up. Here we go. So what he wants is he wants to see the Fed funds rate 1.5% above core PCE. So let's look here. 5.1 minus 3.5 is equal to 1.6. Okay, so that's what the dot plot got revised to. Cool. Let's look out to 2024. 4.1 minus 2.5. Oh man, that same 1.6 here. It's almost like if we try to understand what the Fed is saying and we don't want to fight them, the story is like really obvious. And final thing here before we move forward is that the Fed is currently revising their numbers higher. So they're revising unemployment higher, Fed funds higher, PCE higher, CPI higher, all that stuff. What are they lowering? Growth forecasts. So until the Fed is going to continue to say they're going to do this until the data tells them that we finally have the correct projection, which means that we're not lowering and raising everything, right? We're doing all this choppy action. What we predict is really what's happening. Until then, when they keep raising unemployment, keep raising inflation expectations, and keep raising the Fed funds rate, they're behind. That's what it means. They're behind. They were behind on calling it transitory. They're going to be behind on the way down too. That's literally what this means. Let's move forward now. So everyone's looking at CPI. Oh, inflation peaked. Yeah, but the Fed doesn't care about CPI. They don't. Core CPI, well, this is where the story starts to get even different. Well, we're still above 6 here. That doesn't look good. Why? We need to be above this rate by 1.5%. John Williams said it explicitly. So where do we have to be? Well, if we're looking at core CPI, again, Fed cares about core. So even if we're looking at core CPI, where do we have to be? Well, 6 plus 1.5. We got to be at 7.5. That's like a different story than what the market's predicting. Yes, there's no consensus. Now let's look at US PCE prices. And I don't even have core PCE here. But anyways, let's look at these ones here. So if we look here, let's see if I actually have it on this chart. Core PCE, I think I probably have the wrong one up here. Let's see if I can actually pull it up. Core. I don't know why this doesn't show core PCE anyways. But anyways, let's look here. So PCE, what the Fed cares about. Do we see a trend here like we do on CPI? Nope. CPI, straight off the top from 9 to 7. Cool. What about PCE? No, it's stubborn. Isn't that what Jerome said? It's stubborn? Yes. So this excludes things like energy, things like food. That's why the Fed likes it. They call it the more predictable predictable signal. So 6 plus 1.5, what is that? Well, it's not 5. It's 7.5. That if inflation doesn't come down, the Fed has to go higher. They have more work to do, higher for longer. That's like easy to say. Yes. Also, why does this matter? Well, again, let's look here at, we're looking here to Goldman Sachs. So Goldman Sachs investment strategist for core PCE inflation. Here we got the snapshot back in August. We were supposed to be at 5. We're not at 5. We're at 6 right now. So how are we going to go down to 2 when we look back here to the trend? And it's like, it's really stubborn. It's not going down. It's flatlining here. There's no downtrend yet. High, lower high, lower high, higher high, lower high. That's not a trend. CPI, there's a trend. It's going down. But over here to what the Fed told us they care about, it's not happening. So the projections need to get revised higher. The forecast is not there. We're not making progress back towards 2%. So again, he's telling you explicitly, Jerome Powell told you what was supposed to happen. I was not scheduled to speak, but here I am on Friday morning before the market opens to remind you. They told us. So core PCE, if these numbers are not going to get hit, the Fed has to go higher. He even said 5 to 5.5%. That's what he talked about. And why is the Fed talking about raising rates right now? Because this might be the only chance they have. The market, the economy is strong right now. Let's look at GDP. So we're expecting 2.78% on GDP growth for Q4 right now as of December 15th. So if they don't jack up rates now when we're growing, what are they going to do when we start having a recession? They're going to be hiking into a recession. Right now, there's no confirmed recession. So what are they doing? They're taking every opportunity to get the terminal rate as high as possible so they can reverse course to remember their dual mandate of what? Price stability or inflation and unemployment. If we get up here to 4.6, that's still full employment. Below 5 is considered full. So GDP, yeah, it's going to come down, but right now it's still strong. So they have to hike right now. They have to. And then moving forward here, this is what the market is currently doing. It's fighting them. This is the future path of 3-month average Fed funds rate. So right now, the market is basically calling the Fed's bluff. Where at the end of this year, we have 450 basis points or 4.5%. And then into next year, we raise to 4.8. That's the terminal rate. Doesn't go higher. Peaks in March. Why does it peak in March? Well, let's look at the calendar. Let me get those dot plots. Oops. Let me pull up the FOMC calendar here. Let's look to next year. So as we look here, we're only going to get the SEP in March and June. Until then, the Fed has told us we're on the path. So they're either going to tell us in March or in June. The numbers have to get revised. Which ones? These ones. They're going to tell us, yeah, well, actually, numbers stay flat. Numbers stay flat. They're no longer behind. If they're no longer behind, that's when we can pause. That's when we can pivot. Until then, they have to keep going. And they're trying to convince the market that they're going to do it. Because right now, the market is not believing it. We're going to start cutting rates starting in June. And by this time next year, we're going to be where we are right now at 425. That's where we are right now. We're at 450, actually. We're going to be having a lower rate of interest at the second half of next year than we do now. So the market's predicting a recession, the bond market. The Fed is like, don't get ahead of yourself. Other thing here, don't fight the Fed, the balance sheet. So yeah, they've been reducing for the first time in a long time now. Since when? 2018. Why does this matter? Look, it's simple. The orange line is the Fed's balance sheet. As they reduce the balance sheet, even a little bit, stock market goes where? Well, flat to down. Okay, flat. What about here when they actually reduce it? Oh my goodness, they're going down. Man, stock market crashes. What about here? Well, they've started to take it down. They're going to take it down more, they said. Twice the rate of 2018. Man, that's not looking good. So everything says to be mindful. And when we look here now to the calendar, when do we have relief? Well, either in March or in June when we get that SEP updated that we're no longer having those major headwinds. So let me look through here. It's already been 58 minutes. Hugely long video. I'm going to summarize all my thoughts for the weekend in our group as I do every weekend. Let me just look through here and see if there's anything else because I don't want to make the video like super long. It's already a marathon one. Longest video in a while. So don't fight the Fed. The short term, so the 1 hour, 1 day, 1 week timeframes. We talked about that. What else have we got here? We looked at charts. I think that's it. So in closing here, we're just going to look at the charts again one more time. We're going to look at these weekly charts and just ask ourselves whether or not there's anything here to be excited about. QQQ. First weekly close below the 200. I would not be excited. If I'm bearish, I would be. DXY bouncing off the 50, trending up, trying to bounce off long-term support. Let me actually, I forgot to talk about this. So anyways, the reason why we could reverse as well is because we have, again, not that I'm calling a reversal. I'm bearish, by the way. I'm looking here at the hourly chart on ES, and we finally got a bigger green bar than the red ones, which means if we're going to reverse, we're battling for a primary downtrend right now. We got to take out these relative lows, and that's what I'd be looking for. We're basing right now at 3871. I'm watching reaction to 3,900, reaction to 4,000 potentially, which means we could hit here, back off, curl back up, back off again, and then go for 4,000. That's the potential. We have to see more bull volume to confirm it, and we have to start trending higher. We have to form an uptrend that holds. It's that simple. Now let's look here at weekly charts. Let me actually pull this stuff back if I can. No, I can't. All right, SPY 1 week. All right, so looking here at SPY on the weekly chart, man, it's like not all that great. All-time high connect, we're below it. We rejected off our key low in February already. Now we're rejecting off the 50 again. Not good. IHS potential, that's all it is, potential. QQQ. Nasty, nasty, nasty. More than 30% off the high. Solidly on a green line here. Man, better do something soon here. DXY, bouncing off a primary key area going back to 2017 tops. So dollar wants to go up. Is it a head and shoulders? Let's find out. We're closer to support than resistance, but we have to get back above 106 and then probably 110 to confirm it. We got room to the upside if it happens. We've never seen a bottom in the stock market like we reviewed earlier, 2008, 2000. Where's 2000 here? There's 2000. Without us what? Getting above 40. We have not gotten above 40. We hit high 30s. That's it. So there's no actionable bottom yet. Actionable bottom means we have all the normal conditions to say that the bottom is in. As of right now, we can't. 2-year note, right on an uptrend here, but keep sliding. That'll support stocks. Is it going to be enough? I don't know. Key area here too at 3.8. Relative low versus relative high. 10-year note. This is a really long pattern, so probably going to confuse people. We're stuck between about 3.1 and 4.1. Much closer to support here at 3.1. 2s, 10s, which means the 2 and 10 yield curve inversion. All-time high, baby. At least on this chart, going back to the 1980s, record. So that's a recession warning. Usually 12 months early. Jumping forward here to trillion-dollar companies. So looking here in the 1 week for Apple, it's losing its yellow box, which for me is the demand zone. So massive upper wicks, lower highs. It's looking shaky here. All right, is it going to go lower to the 200? Watching close. Microsoft, right back to the dominant downtrend. It's battling. Maybe have an inverse head and shoulders here. Maybe it can carve out a sideways shoulder. Maybe go higher. One strong chart's not enough. Volume also says to be mindful of the downside here. Google doesn't look all that great. 2 weekly closes below the 200 MA. Rejecting right around the relative lows of the year. Amazon looks just like Tesla. Approaching the end of the funnel here. Is it going to fall out? Is the other shoe going to fall? We looked at all the put premium. Man, it's juicy. Tesla. This is the one that just cracked. Amazon's about right here right now. About right here. Negative 16 on the week. Elon sold 4 billion. Man, decreasing price, increasing volume. Forget it's Tesla. What would you say if this was SPY? Would you say it's bullish? Oh, well, it's below support, so it has to be bullish. I don't know. This says everything means there's more downside. Closing at the low of the week usually means more down. Is it going to be a straight line? Probably not, but it looks soft. NVIDIA, still closer to resistance than support. It's the last one that's actually looking okay here. Oh, my throat's getting raw. Anyways, looking here at Meta, last one. Meta's our new leader. It closed up 3% on the week. Hell yeah, boys. It's bullish. If this is our new leader, I think we might have bigger problems ahead of us. Put call ratio also starting to get elevated. This is for the broader market. So put call ratio for the broader market, looking here at about, this looks really noisy. So it just means we're elevated. Put call ratio for SPY also back up to 1.3. We noted for our platform, it's at roughly 1.45 in the last month and a half. Dow just barely held on to that 50 MA. Barely. And this was the strongest chart other than XLV. So if this one's starting to show cracks, and there's also the bearish engulfing candle, it doesn't look great. So bearish engulfing candle, come on, want the brush, please. Bearish engulfing candle right on the 50. Let's see what happens. IWM, below both. 2 weekly closes below the 200 and below the 50. Doesn't look good. No bearish engulfing, but only managed to make it to the 50 weekly, not the high of last week. RSP, bearish engulfing, 2 weekly closes below. Bearish. NYA, 2 weekly closes below. So 2 weekly closes below, bearish engulfing, bearish. XLK has not closed above the 50 in a while. Bearish engulfing, check. ARC, stinky. Almost all the way back to the yearly, it's all the way back to 2020 lows. Wow, incredible. XLV, bearish engulfing, but still above the 50. XLF, 2 weekly closes below the 200 and bearish engulfing, bearish. Increasing volume too. XLE, there we go. That's it. So again, thank you so much for watching. If you want to join me, Justin from YouTube, and trade with me to see how I take all these notes, just formulate a strategy and to conquer the market, come join us. Thealgo.com, up to 44% off until December 30th. Otherwise, thank you for watching the marathon video. I look forward to seeing you for the rest of the week. All the best of luck this week. Thanks so much.